very, very hard, I think, for people to be able to do that by themselves, simply because, one, it's hard to continue to stay motivated and accountable to yourself. Going back to the training thing, that's why people get personal trainers. I don't necessarily think it's because they need to work on their technique. Maybe at the start you do, but it's because someone holds you accountable.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host, Andrew. Bills, here we are back again, back at our favourite time of the week. Andrew, you said it, took the words right out of my mouth. Let's jump straight into it. We're talking to everybody today about financial advice fees and what you're actually paying for. I actually think this is a great topic. Actually, it is a great topic, I don't think, because I prepped it. Because you did prepare it. Andrew, let's get straight into it. I think this is going to be a fantastic one to give people a greater insight into sort of how our world works. Where do we start?
Yeah, I think where you start is kind of maybe at the biggest misconception around sort of financial advice and what people think they're paying for versus what they're actually getting.
Can I just interject? Yeah, I think this is the government as well too, what you're going to say. Well, I think this is exactly what the government thinks that financial advisors give and charge people for.
Yeah, yep. I agree. And I think that most people have this perception that we're picking stocks. It's not what we do. Yes, there's an element of investment advice. Yes, there's an element of product. Yes, there's an element of trying to find, the thing that's going to optimize a client situation. But the value of advice is in the strategy. It's in the advice. It's not in the selection of product. So what we're doing when we're starting to talk to someone about a financial plan is we're strategically looking at, okay, well, what are we trying to achieve? What are the goals? What are your circumstances? How are we structuring your finances? What's the thing that you focus on right now versus the thing that you can start to focus on in 10 years' time when you've got, the time frame and the financial ability to do so. So it's the decisions that you're making around when you're entering into a financial product and when you're not entering into a financial product, and all of the advice around the financial advice, rather than just selecting what's the best stock to buy, or, what's the best super fund, or, what's the cheapest insurance. So it's the strategic advice where most of the value is actually delivered, not on, getting that extra little bit of alpha on top of, your investment rate of return.
Yeah, and I might just elaborate on that a little bit more, because it comes from a history of where financial advice evolved from, where in order for advisors to get remunerated and paid, they'd have to do it through the placement of a product. That's the way that it was doing it. So there was a conflict of interest there, because, you'd place somebody in a product and that's how you'd get paid. Today, that's all banned and outlawed, and has been for a long, long period of time. So from our perspective,
previously it was a commission on a product, whereas you're not paying a commission there, or you're not receiving any commissions these days. What you're actually receiving is, a fee for the work and the service.
Well, the fee that you're paying is for advice.
Yeah.
Right. And if the advice calls for, and I'll use an example as well too, but if the advice calls for the recommendation of a product, then that's just the extension of it. And people get caught up in that and go, oh, they're recommending a product because there's some sort of conflict or there's a reason that they get that. That doesn't exist anymore. Right. So as an example, advice could be, let's take a different slant and say, okay, you've got somebody who is 46 years of age and takes out mortgage. And if they take out a standard 30-year mortgage, they're going to be in their late 76 by the time they pay it off. Your advice could be, hey, what's our debt acceleration or elimination strategy to have it paid off maybe by the time that you're 65, right? So 11 years faster. That's advice that's got nothing to do with products. Yeah. Then let's take an alternative where you might have new parents to say, hey, we want to start putting some money aside for our child, so when they're older we can pay for university, or we can put a deposit down on the property, or what have you. Okay, yes, you're going to have to invest some money. You're going to have to find it in your cash flow. we're going to need to make an investment recommendation, because if you put it in a savings account, you're not going to get the rate of return that you need to achieve your objective. So we make a recommendation to then invest in a particular product or a particular platform. But the advice is different for the child. The product just enacts the advice. So hopefully that resonated and that helps hit. But yeah, from our perspective, it's advice that people are paying for, and product is just an extension of executing that advice.
Yeah, exactly. And that's why, I mean, whenever I'm sitting in front of a client, whenever I'm talking to a client, everything that a financial advisor should be thinking about is strategy first. So you don't even discuss product, you don't discuss, investments or asset allocation or anything at all until you actually know what the strategy is. Because the product and how you structure that should only help you and assist you in achieving what you're actually trying to achieve.
Yeah.
When you start with a strategy, when you know what the strategy is going to be, the product slots in underneath it, and it can be very clear what the product is. When you start with a product, what are you doing it for, and how does that actually help you in your circumstances? Well, you don't know until you know strategically what you're doing.
It's all strategy. Yeah. It's all strategy, and everything flows from that. And even what sits behind or in front or on top of that, client circumstances, goals and objectives, where do they want to go? And then we start putting the strategy together about how do we achieve those things. If everything's possible, fantastic. If there's not, what's the trade-off that we need to have? And then once again, leads into some sort of recommendation around a course of action.
Yeah. And I think that when you are starting to talk about the strategy, I guess, first things first, you're looking at cash flow. When you're looking at, are there ways to optimize cash flow? Are there ways to streamline this and make this easier to manage? You're looking at, from a tax perspective, what are the tax obligations depending on which sort of path we go down, whether it's an investment in superannuation or whether it's an investment outside of super. The liquidity, can you access that fund or can you access that money? So it's not just to get you to this net wealth, but if it's in, for argument's sake, super, and you're not going to have access to 60, or you're not going to have access to 65, but your objective is to retire at 55. Well, that's not the right thing to do. As Billy said, the debt strategy, when and how are you going to expunge the debt that you have? Because, most households in Australia have an element of debt. If you are, purchasing a property or investing in property, how do you, reduce the risk in the underlying portfolio? So, the intangible of, you being self-employed and holding assets personally versus holding assets in another partner's name or a trust, the insurance piece to it. So the outcomes are really created in this strategic advice. They're not created in selecting a fund or selecting a product. The selecting the fund and the product is naturally what you're trying to do to optimize the situation, but really building the strategy and building how you factor in all of those conflicting interests, right? Because investing has a tax consequence, because when you make money, you're paying tax. So normally there is no better or worse, there is just trade-offs. And so what you're doing is looking at, all right, how do I cover off on all of these trade-offs in someone's situation to make sure that I'm still going to get them from point A to point B, and I'm going to take on the least amount of risk to do so along the way.
Yeah, and look, the other thing too that, we're going off on a tangent here as well too, but the other thing too, from a financial advisor's perspective, we talk about the fees, the advice fee, and it's no different to any other professional service that you engage with. You're paying a fee for service. Financial advisors have a best interest duty. So exactly like the name suggests, we have a legal obligation that when we are delivering advice, the advice has to be in the best interest of the client. We need to prioritize the client above and beyond anything else, including any of our own staff. If there's a conflict of interest, we need to address it, we need to raise it, and if we can't resolve that conflict, then we can't give advice. So the law is very, very stringent around what this looks like. It's professional service fees, exactly the same way that you'd go to your accountant or your solicitor and they're going to do a piece of work for you.
Yeah.
They will deliver you advice. The only difference is with them is that in order to enact their advice, chances are there's no financial product that's recommended as part of that. And I think that's a little bit where the disconnect comes in with that. Andrew, the next one I wanted to talk about was the implementation. So going back to what I was just saying before, if we make a recommendation and through our advice and matching that strategy and the client goals, and we need to use a product or we need to do something, implementation is usually where it falls over. Most of the time you're engaging with a financial advisor, there'll be an implementation component to the advice that they're recommending as well too. If it doesn't get, and it's like anything, right? But if it doesn't get implemented, nothing's going to happen. So it could be, I go and talk to a personal trainer, but if I don't go to the gym and follow what they say, nothing's going to happen. I might feel good, but nothing's going to happen. Or, you go and buy a new pair of runners and with the intention of running, but you never actually run, nothing's going to improve. So implementation is a big one. A lot of people do tend to fall over there because they don't.
It's an accountability case, right? Like it's very easy to, like you can understand how it happens, the amount of times that you say, I'm going to do something, but life gets in the way, things get busy and you just don't prioritize it. Whereas having someone there that, their job is to make sure that you follow through with it means that the outcome is not guaranteed, but very, very likely as opposed to, something that may or may not happen. And this is, important, especially when you're starting to talk about things like a debt piece. And I know that we've got some a little bit later on around sort of the ongoing and ongoing management. But when you are starting to talk to people about, hey, did you know that, at this stage, if you continue doing what you're currently doing, you're going to expunge your mortgage, but it's going to be at 75 years old and you probably want to, stop working at 65. Well, with an extra $150 a fortnight, for argument's sake, in additional repayments, that's going to mean that your mortgage is going to be completely paid off by the age of 65. It's all good and well to talk about and say, yeah, great idea, I'm going to do it.
Yeah.
But without having someone there to be able to say, have you done it? Check. Is it actually done? And are you following through with it, in subsequent and future years to make sure that you still get there? And if there is an interest rate rise, well, what impact does that have? Because all of a sudden the interest component of your, repayments is higher and your cash flow position is lower. And what changes does that mean to be a strategy? So it's making sure that, all of the best laid plans are actually followed through, is usually a success or fail metric at the end of the day.
Yeah. One of the other things that you're really paying for with financial advice, and this is not only in the initial engagement, but also in an ongoing engagement with an advisor, which we'll talk about next as well too, is that making the wrong decisions at the wrong point in time. That is a huge one. And probably the best example of that is when markets are volatile and people are looking at it and, they're hearing noise. And, what we're going through at the moment is a perfect example of that, but they're hearing the noise and they might be panic selling and going, okay, everything's falling apart. The investment strategy that they've got, or they're thinking, or they're not thinking, they don't stick to it and they make the wrong decision at the wrong point in time. That's probably the biggest one that we tend to see. The other one is that people get caught up in trends and FOMO, fear of missing out. So they start to chase trends, can be quite dangerous from that perspective. And I think ultimately, which is the biggest one, is the making emotional decisions, because money is quite emotional, and it's very, very hard to stay objective when you're dealing with your own bundle of money. That's why you need to pay for advice, because it's impossible to be able to stay objective when it's your own money.
Yeah. And I think, this is the hardest to demonstrate, because it is an intangible, and no one goes into it thinking, I'm going to be the type of person that, I'm going to panic sell and I'm going to, jump on a trend, and, no one goes into it thinking that. And so really trying to demonstrate that, hey, the conversations that we're having along the way and me stopping you from making a really bad decision is, I don't know, it's one of the most important things that I think that a financial advisor does. And it's, as humans, I think that we rationalize our decisions in such a way that you almost don't notice it. Like I was talking to a client fairly recently, actually, and they were a new client, and he had sold an investment property. This is going back sort of about 12 months ago. And he sold that investment property because it was too expensive to hold property in Melbourne. He was concerned with the cost associated with owning an investment property. And we're now having a conversation about building a financial plan. And he's talking about, well, property is really cheap in Melbourne. It represents really good value. And is it time that I get back into property? And we sort of sat back and looked at it. And, this is the perfect example of panic selling and then, making an emotional decision to buy back in. And what's the likelihood? And, some of the conversation we're having was, look, okay, maybe you've made a mistake in the past and maybe it wasn't the right thing to do with selling. So do you then say, well, I'm going to double down and I'm not going to buy now? No. But you have to recognize that there was an emotional decision that was made and the transaction costs of paying capital gains and paying stamp duty and doing that again is incredibly high. And if there's a likelihood that we're going to do that again, maybe this isn't the right vehicle for you and having, and so those are the types of conversations that you're having aside from just, start and end outcome and what's the best thing to do. You're actually looking into some of the decisions that someone has made in the past and are you likely to make that same decision again? And can we have a conversation about this to determine, what is the right product and strategy to help facilitate your goals and minimize the risk, loss aversion in the future?
No, well articulated. Financial advice, we tend to view it as do most financial advisors, that it's never a one and done most of the time.
Yeah.
It's usually, it's not set and forget. It's usually an ongoing relationship. So if it's a small transactional piece of work, it can be. But for a lot of people that are getting a financial strategy put together, it's never usually one and done. Life changes, laws change, market changes. There's accountability piece with it as well too. And the simplest explanation that I tend to use and tell people is basically saying, okay, we've built this financial strategy. We're starting, if you picture a graph, we're starting in the bottom left-hand corner, which is today, time across the x-axis, wealth across the y-axis. And basically you've got a line going up in the top right-hand corner and saying, okay, this is what we want to achieve if we're representing the strategy on a graph from a wealth and a time point of view. If you think about all of the things that happen in the world, in your life, everything, staying on track as per that original strategy and projection, you need somebody in your corner to be able to make sure that you're staying on track with that and making tweaks and changes to your strategy as things either in your life change or as things in the investment world change as well too. And it's very, very hard, I think, for people to be able to do that by themselves, simply because one, it's hard to continue to stay motivated and accountable to yourself. Going back to the training thing, that's why people get personal trainers. I don't necessarily think it's because they need to work on their technique. Maybe at the start you do, but it's because someone holds you accountable.
Yes.
And the other thing too, whether people like it or not, is they don't have the expertise to keep all of these things going, because there's a lot of balls to juggle and there's a lot of expertise that sit behind it in terms of the things that we're monitoring and managing and tweaking and changing and looking out for.
Yeah, and the market changes. I mean, you talk about, investment market, you talk about tax environment. I'm sure that in the coming weeks, we'll be doing another podcast on, some of the CGT changes that are likely to happen, tax code in Australia. And so as things change, I mean, for instance, depending on what happens with the CGT changes, bucket companies and owning property in, companies didn't make a whole lot of sense because of the no access to the capital gains discount. Now, all of a sudden, if there are changes to the capital gains discount, maybe that opens up another investment and structure and holding your assets. So as things change, not just in your own circumstances, but in terms of tax opportunities and in terms of market, I think it's really important to reassess your situation, reassess how you're doing things, and if there is another or a better way to be able to do it.
Mm-hmm. Yeah, agreed. What do you get with advisor fees? Access to expertise and network. So it's not like what we were talking about before. It's not, hey, this is the solution and that's what you get. As an example, if you went to a property development seminar. They're going to sell you a property in a project that they've got, because that's how they make their money. Financial advice, you're getting access to expertise. You're getting somebody who's giving you personalized advice around a whole broad range of areas that have expertise in those areas. It could be debt management, it could be cash flow, it could be investments, it could be insurance, it could be wealth creation. The list goes on and on and on. Technical knowledge, it could be, particular strategies associated with, managing debt or managing investments, coordinating with your account, with your lawyer, regulation insights and taking advantage of changes that are coming up. Superannuation is a huge example of that, with your contribution caps and the limits and some of the things that you can do in there.
Yeah, that's what they should be. I mean, a good financial advisor should be tying in with your accountant, with your lawyer, with your mortgage broker, and everyone is looking at things from a different angle. And as you start to, get all of the right people in the room talking together, all looking at your situation, the outcome that leads to is far, far greater than looking at it in isolation.
Yeah. The last point that I reckon I think we should close on is when you think about cost versus value, because a lot of the times that we have a conversation with people and go, okay, I'm going to engage with a financial advisor and pay a fee, there's almost an automatic assumption that it means that I'm going to outperform the market. And if I spend $5,000 on advice fee, you're going to make me 10. Right. And I don't necessarily think that's the fair way, because there's so much value that is created that's not necessarily captured and represented by dollar value. Andrew, let's run through some of those.
Yeah. And I think that when you are talking and, maybe some people have a financial advisor, and maybe this is a way that you can, assess whether that relationship is working or not, is really looking at, okay, as a result of, what I'm doing and what I'm getting, is my tax position better than what it was previously? Am I building wealth for after? I mean, you also can't underestimate, would you be putting the same amount of money towards investments, or would it more likely be that you just would have spent that money because it would have been in your account? Am I making fewer mistakes when it comes to money? Like, have I made financial mistakes that have cost me a significant amount of money in the past? And is that no longer the case anymore? Am I just clear on what my strategy is, what I'm doing, how I feel about money, and do I have actual peace of mind around where I'm heading and what it is that I'm doing and why I'm doing it?
Yeah, well said. And I think the last one, just to tie a nice bow around it, is the peace of mind that comes with having that in place and knowing that, hey, I've got someone, they're checking over it, I'm making the right decisions. That gives me a sense of peace of mind that we're not going through life, with all of the struggles and the grind and the 9 to 5 and, family commitments and what have you. And then we're going to wake up one day and go, geez, I wish we had addressed this earlier, and we've gone and lost a decade or two. Yeah. So I think the peace of mind that comes with it as well too. And how do you put value? And it's exactly like, say, why do people insure their car? The peace of mind. You can't put a value on peace of mind.
Yeah, absolutely.
Andrew,
thanks again for another great podcast.
Thank you too. To our viewers and our listeners, hopefully you've got a whole heap of like, subscribe, share with your family and friends. Details are in the show notes if you want to reach out to Andrew and I. And we look forward to catching you on the next one. Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au. The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of Akumin Financial Planning Pty Ltd.